answer that question, we need to look at what central banks are and how they operate. And that allows us to explain how banking works and why we have the recurring banking crisis. So let me do that.
Yeah, please.
In fact, it goes back to a fundamental question. How do banks operate? And actually there have been 3 theories on banking for over a century. 3 different explanations, and I'm sure you will have encountered all 3 at one stage or another. The currently dominant theory is that banks are just financial intermediaries, and this one is being reinforced a lot by the financial news reporting, by statements from central banks, and also if you look into academic and research literature, the leading journals, say the Journal of Finance, American journal, considered #1 in the area, it considers banks nowadays as financial intermediaries. What does this mean? It means the banks gather deposits on the one hand, then they do their thing, their analysis and their credit risk assessment, all these things, whatever it is, good or bad, and then they lend those deposits. So they're just in the middle, a middleman. There's the middleman theory of banking. That one is currently dominant. And also bank regulation, how actually regulators look at banks and how they regulate them. The entire approach to regulation, which you know is this Basel Approach. We can come back to the specifics, but this Basel Approach is also based on the assumption, the belief, that banks are just the middlemen. They gather deposits and they lend them out. Now, if you go back in this Journal of Finance to the 1960s, you might get confused because it's the same journal, but in the 60s they were talking very differently in this journal. Because then, still, just about, the previous theory of banking was dominant, which was dominant from the 1920s to the 1960s. And that one, you will also have heard, maybe once or twice before, the fractional reserve theory of banking. This one is connected to another concept known as the money multiplier. I think a lot of ears of those who haven't looked into economics and finance should prick up now. When I was a student and I heard this money multiplier, oh, that sounds interesting, I thought. What is that? The money multiplier, the magic money tree. So, well, just very briefly, in fact, there's a similarity of the fractional reserve money multiplier theory of banking to the middleman, intermediary theory of banking. Namely, it says, yes, each individual bank is an intermediary. So also this fractional reserve theory also says that. But they say, as you put many banks together, so you've got many banks now, they interact and they do their things, overlapping, interacting, then something happens. Somehow in this system, as the banks interact and operate together, money is being created. There is money creation going on. It's not the central bank. We're not talking about central bank money creation, okay? Now, the actual technical details are a little bit complex. Students are always confused, and there's actually a reason it's meant to be confusing. So don't worry if you think this sounds a bit confusing. You can look it up later. Fractional reserve theory of banking, money multiplier. The main point is, it says each bank is a middleman, an intermediary, but in aggregate, collectively, and it's interesting that there's a recognition, we have to look at something systemic, which is different from each individual bank. Something happens and money is being created. And of course, you can imagine if that's true, and if money is being created, this will have an impact. There will be some consequence. This, therefore, means there should be a different approach to bank regulation. And the approach to bank regulation, going hand in hand with this fractional reserve money multiplier theory of banking, is the old reserve requirement approach to bank regulation, which was dominant, in fact, during that era when fractional reserve theory itself was dominant, which was until the early 80s, 1980s. Even the Federal Reserve and the Bank of England were looking at reserve requirements. It's a bit monetarist, you know, looking at money aggregates. But then that was scrapped as from the 60s, 70s onwards, this financial intermediation theory of banking became dominant, and then we have the Basel Approach, which is all about capital adequacy. It's all about capital, not reserves. We'll come back to this regulation, but okay, now there's one more theory of banking. You need to hear the third one now that we've come this far. Namely, until roughly the 1920s, this theory was dominant. And this theory says that no, banks are not financial intermediaries, neither individually nor collectively. So this is a different theory. This theory says when a bank gives out a loan, a bank loan, we're just talking about ordinary banks, commercial banks. When they give out a bank loan, then money is being created. Money is being created essentially out of nothing. Economists tend to write ex nihilo because it's a bit embarrassing, out of nothing. It's too obvious. It sounds too shocking. So put it in Latin. It sounds more technical. This theory was dominant until the 1920s. Now, we've got these three theories. If the oldest theory, that banks create money, is known as the credit creation theory of banking, is correct, then you need also bank regulation consistent with that theory. And it's not the fractional reserve approach and the reserve requirement approach, and it's not the Basel approach. Notice the Basel approach has not been very successful. We've had so many banking crises since the Basel approach was introduced in the 1980s. Basel I, Basel II, Basel III. It's like these, movie installments.
Yeah, could you just briefly explain what that is? I'm not sure everybody knows what Basel I, II, III is.
Yes, this is the currently dominant approach to bank regulation. And the fundamental idea is that, we can somehow contain and control and regulate banks if we give them a requirement to hold capital, what's called as capital. Now, what's this capital? It's just, when you look at a balance sheet of any company or also a bank, you've got equity from shareholders, that's the capital. There's some slightly different types that can exist, but we don't need to go into this. So that's the capital. And banks, so before the 2008 crisis, had not much capital. The large internationally operating banks had capital around 2 or 3% of their balance sheet. That, by the way, is already a quick explanation why we've had all these banking crises, because you can have them very quickly. Particularly if the oldest theory of bank behavior, the credit creation theory, is correct, that banks create money. This will have consequences. And then the Basel approach imposes capital requirements. You must hold 8%, simplified, and it's not quite true for the big banks. It's actually much less than 8% of your balance sheet in capital. Then this is some kind of security to ensure stability, was the thinking. But it's not true, because, and to answer this, we must now ask this fundamental question. I'm sure you want to finally hear this. So which of these three theories is true? And then I can answer your question properly about Basel. Which of the three theories is true? Because Basel is linked to the currently dominant theory that banks are just intermediaries. And if that was true, then Basel has a chance to work. Now, we have famous economists supporting all of these theories. The credit creation theory is supported by Schumpeter, for instance, Austrian economist. And we've had and also the young Keynes supported that one. Then the fractional reserve theory is supported by Alfred Marshall, famous neoclassical economist, and also by the slightly older Keynes, and by many other economists. And then we've had the financial intermediation theory, which is supported by essentially all economists nowadays. But which one is true? Well, we need to test this empirically, is what I thought. Over a century of debates, but no empirical test. What is the scientific way of doing this? Empirically test this. Well, all the three theories differ when it comes to the question of where does money come from? I've actually written a book with that title, Where Does Money Come From? Because when you take out a loan from a bank, the question is, where does the money for the loan come from? That's where the three theories differ. The financial intermediation theory says, oh, the banks take deposits and then these deposits are lent out. So in a loan, the money comes from deposits. The fractional reserve theory says that the banks need to hold excess reserves in order to lend. And so the money for the loan comes from excess reserves. And the credit creation theory, you may guess this one, says the money comes from nowhere. The banks create the money out of nothing, because that's the most shocking theory. So I ran this experiment a few years ago. I actually took out a loan from a bank, and the bank was collaborating with me in this experiment, this empirical test, because I told them, look, I will take out the loan, I will transfer the money away from you to my own old bank, and I want you to show me exactly what you're doing, what transactions, what bookings you're doing internally in your system. I want to see where the money comes from that is booked into my account. It's a reasonable approach. It took a long while to get a bank to cooperate. Initially they all said, yes, sure, we'll do that, the big banks. And then when it comes to actually wanting to see their systems, oh no, this is far too sensitive. And all sorts of reasons you cannot see this. But I managed to find a bank in Germany that collaborated. We actually had the BBC there filming this empirical test. I took out a live loan, 200,000 euros, and I was going to transfer it away from the bank. And we looked at the bookings and what they did, and it turned out, where did the money come from? It was not transferred away from any other account inside the bank or outside the bank. It did not come from deposits. It did not come from reserves at the central bank. In fact, they didn't care about their reserves. They didn't even look how much they had. Reserves were not affected. It was newly created. How does that work? Well, the best way to understand this, if you look at the law, and this is, of course, one of the reasons why economists don't understand banking, and they leave out banks in all their economic models, because they never look at the law. Law is reality. If you've got an issue, well, you can use the law to claim your rights, and the court will decide, and that is the result. And you can challenge it to higher court, but ultimately, the highest court will make a decision, and that is it. That's reality. So what does the law say about banking? Economists consider banks as deposit-taking institutions that lend out money. That's the standard definition by economists. But when you study the law in the country that invented modern banking, which is England in the 17th century, and that's also when this legal system was created, and it's still the same, the law tells us it's a different story. Banks are not deposit-taking institutions, and they don't lend money. That's what the law says. How does that work? At law, and we have Supreme Court judgments on this, there is no such thing as a bank deposit. It doesn't exist. So what is it when you deposit your money with a bank? We have the feeling, and we're given the impression, that when you put your money with a bank, it's my money. In fact, I did a survey, and people respond, no, the money at the bank belongs to me. That's my money. I'm holding it in deposit the bank. They're taking care of it, but it's my money. I can ask my money back any time. But at law, that's not true. At law, there is no such thing as a bank deposit. It's not held in custody. It's not held for you. You are not the owner of the money at the bank. The money held in deposit at a bank is owned exclusively by the bank. It was your money before you deposited it. When it's deposited at the bank owns it, and what rights do you have? Well, you're a creditor. So what that means, the money at the bank is a loan that you've given to the bank, and you're just a general creditor. So that's why banks don't take deposits. They borrow money. We lend it to them. We are general creditors. They own the money, and they can do as they please They're the owners of this money at law. Very clear cut. Okay, but surely they lend money. What else would they do with this money? No, there is no bank that has ever lent money. At law, again, very clear cut. How does that work? Very intriguing, I thought.
That would be my question.
You go to a bank and you say, I want to borrow money. Now, an important thing is the loan contract. And they will make you sign it. Now, what happens at law is, the moment you've signed the loan contract that you will borrow X amount of money and you will repay this money at this date with this interest, whatever, that moment, once you've signed it, you have issued a security, a debt instrument. That's what this loan contract is at law. So what the bank does when it gives you a loan, as we call it, or lends you money, as we call it, at law, they do no such thing. They're in the business of purchasing securities. They will purchase the IOU, the debt instrument that you've issued. The bank will purchase this from you. Okay, fine, I don't care. I just want the money when I get my loan. Ah, you're right. The bank now owes you money. So the bank owes you money. Well, that's what we call a deposit, right? A deposit is when the bank owes you money. And the record of how much money the bank owes you, we call a deposit. And that's what you get. You get a record of how much money the bank owes you. And that's all you get, because that's what the banks do. So they purchase your debt instrument, and then they record their debt to you. And here's an accounting trick, and actually in another paper published, you find it online, I could demonstrate that there is actually a slight, aspect of incorrectness, let's put it politely, in banking. Because technically, from an accountant's perspective, they now have an accounts payable liability to you, right? You've signed the loan contract, they should give you money. Accounts payable, liability for the banks. But the banks will book this now, this liability called accounts payable liability, as another type of liability, which sounds much more convenient for bankers, namely customer deposit. And that's how they'll show it to you, and that's in your account. In other words, the bank will invent a fictitious deposit for the borrower, and that is how the money supply is created. I did a survey in Frankfurt of 1,000 people. Students helped me to do this, and we asked in the streets around the university, so probably slightly above average educational standard, but doesn't matter, bias maybe in the right direction. We asked them, who do you think creates the money supply in the economy, the majority of the money supply? And of course the majority, over 90%, responds, it's the central bank, isn't it? Central bank or the government. But that's not true. The central bank only creates 3% of the money supply. And the correct answer is the majority, the vast majority, 97% of the money supply is created by the banks when they lend money. So this was the result of the empirical test as well. Turns out the money supply is created by banks. And where does the money come from for a bank loan? It's created out of nothing by the banks. And because of that, so it's the credit creation theory, the oldest theory, which is correct. It's now been empirically proven. You can look up the paper. If you Google, can banks individually create money out of nothing? You will get it. Probably even shorter, you will get it. It's the most downloaded research paper of any Elsevier academic publication.
Yeah, Elsevier being a major scientific publishing house, right? Yeah.
Thank you.
I want to...
And that means it's the oldest theory that's correct, and therefore, for bank regulation, to come back to your question on Basel, we need a bank regulatory approach that recognizes this reality that banks create money. The Basel approach uses the financial intermediation theory and thinks by having capital requirements, we can contain the banks and avoid crises. And it's not true because it's the credit creation approach which is correct. Banks create money out of nothing. And have you heard of Credit Suisse or Barclays in 2008? How they got out of the crisis? They were actually as bust as all the big banks. Remember, in 2008, But did they go bust? Did they need public money?
No.
Neither, they didn't. What did they do? They were clever, they were aware of this, and the decision makers in the crisis, under crisis, you're under pressure, they remembered, well, banks create money out of nothing. Why should we go bust? They created their own capital out of nothing. How do you do that? Well, you need a borrower. There was a borrower, the sovereign of Qatar. They had relations with them, business relations, and so they needed suddenly 10 billion, roughly, let's say $10 billion worth of capital. Well, let's create it out of nothing. Let's lend it to somebody like Qatar. Obviously, it needs to be a big player to borrow 10 billion and be credible. They will buy our newly issued shares of 10 billion, and we can create the money out of nothing for our capital. And that's exactly what they did. In a way, we shouldn't do what is now being done in the UK. The Serious Fraud Office is going after them for fraud. Well, they're just doing banking, and they save the taxpayer billions and billions in money. In fact, this tells us that we can get out of any crisis without using taxpayers' money and without reducing public welfare spending as a result and austerity, because we can just use the reality of bank accounting to get cleanly out of any banking crisis. And this is also what central banks have done in the past when they didn't want a banking crisis to turn into a major recession. They just solved the problem like this. You can do it in one morning, and you will not have a real banking crisis, and you will not have a recession. This is what Ben Bernanke did in 2008. And he was actually, I proposed all these things in the 90s in Japan in these big debates we had where I also proposed quantitative easing. And Bernanke was joining these debates. And he was, in 2008, the only central banker to implement my advice, the true quantitative easing, because the other slightly changed the definition. Step one, you have a bust banking system. The capital in the Basel Approach is not enough. It's this tiny amount anyway. And when the banks create money, use it for financial transactions, push up asset prices by 300-400%, which is due to banks creating this money for financial transactions. At the peak, if then asset prices drop by 10%, you've used up all the equity for the non-performing loans already. You're bust. So that's why we have the banking crises. So how do you get out of this quickly at no cost to the taxpayer? It's very simple. The central bank steps in, goes to the banks and says, oh, you've got non-performing assets larger than your equity, you're bust, all of you. Bust banking system, always the same story. No problem, because we don't want a banking crisis now turning into a big recession. We will let you off this time. We will put in place measures to prevent this in the future. We'll talk about what those are. But we'll get you out of this one now. And you don't use tax money. That's expensive. That increases national debt. Ireland was a fiscal poster boy. But because the ECB forced it to fiscalize all the banking non-performing assets, Ireland became bankrupt, had to call in the IMF. No, we don't do that. The central bank steps in, goes to the banks and purchases the non-performing assets at face value. And the problem is solved. There's no cost. And this is exactly what Bernanke did. That's why in September, October 2008, the balance sheet of the Federal Reserve quadrupled in 1 month. This doesn't create inflation. Some people thought at the time, wow, we're going to get hyperinflation now. They're inflating their way out. No. If you want to create inflation, some countries try to do this allegedly, like Japan for 20 years. It's not going to work with this method because it doesn't create money, because you're just shifting assets between the central bank and the banks in the right way, away from the bank balance sheets where they are harmful to the central bank, where they can't do any harm. But you don't inject money into the non-banking sector, so you can't create inflation. Oh, but hang on, the dollar is going to collapse. Well, no, as I said at the time, and it's strengthened. Why? Because you're not creating money, you're solving the problem in the banking system. The banks are healthy again, have strong balance sheets, and can lend again. And they did in America. It's the first country to get out of the crisis. Since then, very strong bank credit growth. Unfortunately, too much. That's why we're back in the same spot. They continue to create credit for financial transactions. That's how you prevent getting into this situation in the first place of banks being unstable. Because banks create money, you have to split the stream of credit creation from banks into two, for the real economy and for financial transactions because they're not part of the real economy. And if banks create credit for financial transactions, you are creating an asset bubble, which is always unsustainable and will always lead to a banking crisis ultimately, if it's large enough. So in the early 2000s, I was warning that in Europe, the ECB, which is newly created, was going to create bank credit-driven asset bubbles, banking crises, unemployment, large recessions in the Eurozone. And that's exactly what they did in Ireland, Portugal, Spain, and Greece, based on 30% credit growth for how many years? 3-4 years. Way ahead of GDP growth. This is all credit creation by banks for asset transactions, property, real estate. That's how you blow up these countries, and that's what the ECB did.
You mentioned the real economy. Where are the banks, where is the banking sector, where are the central banks in all this? Do they participate in, as they create money, do they create value? Are they part of the larger GDP? What can you tell us about that?
First of all, what is the link between banks and GDP? The banks have a crucial role. They are, in what we call our market economies, the decision-making control center of the entire economy. Why? Because they create the money supply and they decide who gets money for what purpose. Is this an important decision? You bet it is. In fact, that is the decision that completely reshapes the economic landscape in just a few months or years. The decision of who gets purchasing power for what purpose, newly created money. So the banks are the control center in the economy, and that's why we need to distinguish between bank lending for transactions that boost GDP. Then you get high economic growth, no inflation, job creation, everything is stable. You get also less inequality, you get more equality. But if banks create money for unproductive purposes, either for consumption, then you get only nominal GDP growth, but low real GDP growth, you get inflation. That's not good, that's well recognized. But the biggest problem has been in the last 30 years, banks creating money for unproductive purposes that are asset transactions. That's not part of GDP. And when banks do this, bank lending for property, bank lending for asset, stock market, whatever financial instrument transactions, lending to private equity funds, to hedge funds, investing in financial instruments, which banks do a lot because all the leverage of these funds comes from banks, plain old bank lending, bank credit creation. So this money creation for asset transactions, of course, is pushing up asset prices, creating these asset bubbles. While it happens, it looks stable because we're all making money, we're all having returns, but they're all based on the capital gains and the expectations of capital gains, and that will continue only as long as banks continue to create new money for asset transactions. It's a game of musical chairs. If we took out all the chairs where nobody's sitting, and then only have all the chairs where you're sitting in the room, and then we take one out, and we ask everyone to stand up, we take one chair out, right? This game of musical chairs. And we have the music on, and if the music stops, everyone has to sit down, but one chair is missing. Well, this is the credit creation for financial transactions. It's a game of musical chairs. When the music stops, that's when the banks do not anymore expand credit creation for financial transactions, but they stop it or slow it. Then there won't be enough chairs for the speculators, those who've borrowed money and invested in financial instruments, to sit on. There will be bankruptcies. But the moment there are bankruptcies, banks will have non-performing loans, the banks get more risk averse, they reduce lending. Then as they reduce lending, asset prices come down further. There's fewer and fewer chairs. There's more bankruptcies. And of course, you will end up with a massive banking crisis. That is the mechanism. So, therefore, the answer to your question is, one link is that actually banks are at the heart of the allocation of resources, and they can determine by their decision who to lend to, whether we'll get high and stable, equitable economic growth without crisis and without inflation, which is possible. That's the scenario that East Asian economies have implemented through, in fact, I haven't told you, what is the regulatory bank regulation regime in line with the credit creation approach to understanding banks, which is the true approach. It is credit guidance, direct guidance of bank credit, window guidance, also known as credit controls. Sounds a bit harsher, but credit guidance is more in line, and that's been the key tool used in Japan, in Korea and Taiwan, and then adopted by Deng Xiaoping in China to create the Chinese economic miracle of high growth. And if you do that, you will get your high growth. But if banks create credit for asset transactions, you will just create these asset bubbles, banking crises, and higher inequality, and all these problems. And that's, of course, what's happening in most other countries. Because the bank regulators have not asked the banks to create credit for productive purposes. It's quite extraordinary. You know, the banks make these key decisions, but nobody's told them, oh, be careful when you make this decision. You should create credit and lend mainly for productive purposes, for business investment, for implementing new technologies, for increasing productivity, which creates jobs, is non-inflationary. Even at full employment, you can have more growth if you have productive credit creation. There's almost no limit to growth, because the limit is the technology, the ideas coming from humans, as long as we have humans. And we can have more humans if we have quantitative easing for having more babies. QE, baby bonus, created by credit to have more babies, fertility shoots up. You know, all these things are possible. Once you understand credit creation, all the problems that we have that have to do with the economy, including demographics, can be solved. But the second answer to your question is, how do banks fit into our standard statistics of GDP? And that's a very profound question you're asking there, because even the statisticians doing, making our GDP accounts, national income accountants as they're known, and every country has a big agency calculating this with very smart people, even they haven't really solved this problem. The other answer to your question, because when we calculate GDP, we've got the expenditure measure, we've got the income measure, and the output measure, three approaches. Normally we talk about the expenditure measure, consumption, government spending, investment, net exports. Where do banks fit into this? How do we get banks into this? Actually, it's really not clear. Why? Because the approach in national income accounting is that you measure value added. You measure value added and you add it up. So where do banks fit in? What is their value added? Good question. They're supposed to be, according to the official theory, they're supposed to be only an intermediary, a middleman. There's not really meant to be a net value added, because if the middleman margin that they charge, if we call that the value added, will be tiny, supposed to be tiny. But of course, that's not what's happening. The banks are essentially claiming a lot of resources that they're paying out to themselves, and that is somehow, they're actually not a value added in reality in most countries to the economy. They're like a net drain, a cost, a loss. So the national income accountants have to say, okay, but it's too complicated to try to figure out what banks are adding value in the economy. Maybe there is not much visible going on. So let's just create a theoretical value that they call it imputing, and let's just assume a number, and let's just plonk that there and add it onto GDP. And that's what they're currently doing, because the fact is, with the sort of banking system we have currently in most countries, it's not clear what value the banks are adding to the economy.